We've brought to you this very interesting piece, very analytical. I think it's going to be, I think once we boil all the numbers down to something tangible, it'll be very, it's not going to be life-changing, but it's going to give some context, especially for those people who trade the zero.
Don't forget, Anton, every Thursday we do a zero DT piece because that's what our viewers want. And that's what Tasty Nation wants, because they still do trade a lot of zero DT, even though there's not that much edge. And you'll see another example of it today. It does keep the kids engaged. So let's do it. The right implied volatility for zero DT trades.
Are you telling me we do them every Thursday? I know, I do them every Thursday.
Hey, you're here as a guest, okay? We'll ask you the questions.
Okay, so you want to take the slides and I'll do the explanations?
How many times have I told you? What is your role?
It changes depending on how we're sitting. You know, if Tony's here or not.
But just remember, if we're in a booth and like we're broadcasting a game, okay? I do the play-by-play. You do the
color.
Right?
Color.
Okay, I do the play-by-play. You do the color.
And get lunch.
Okay, you got that?
Got it, sir.
You're the best. The implied volatility underlying is the standard deviation of annual log returns that would make current option prices fair under a Black-Scholes model. Because Black-Scholes does not perfectly describe the market, and market participants know this, in reality, every option traded has its own implied volatility. But when looking to select strikes based on expected moves, we are forced to narrow it down to a single implied volatility. Which implied volatility has done the best job of anticipating open to close SPX action? So which implied volatility has the best job? I assume they're talking about which implied volatility durationally, right? Is it the 0D? Is it the 1D? Is it the 30 days? Is it whatever it is? Let's go to the next slide.
May I add some color, or would you like to go?
No, you are the color guy. You can add color.
Okay.
We don't have any Scott today. We can go.
Okay, wonderful. So this piece talks about the different metrics of implied volatility we have, right? And the thing is, we have more and more as we get kind of more people trading options, different durations, right? We just had the one-day VIX come out, right? Since we have SPX options every day, now there is an implied volatility basically for each day, depending on where you look. If you look at the right-hand side of the options of the expiration bar, you'll see the IVX number. It's going to be different for any expiration, even if it's just day-to-day. And what we're trying to show here is, okay, which expiration or which IV does the best job of predicting the expected move as close to theoretical as possible? That's the question.
Okay.
Okie
So we considered three possible implied volatilities. The average of the implied volatility for the at-the-money 0DT put and the at-the-money 0DT call at the market open. We used the CBOE published VIX, a mixture of option prices from the at-the-money through the second zero bid out of the money, using weekly expirations, averaged around 30 days to expiration. This is the most popular market volatility measure and has an extremely active cash-settled derivatives market. That's the primary. And then the more esoteric VIX one day, which follows the same methodology as the VIX, but uses a mix of daily options expiring the same day and the next. I didn't say this was easy today, Tony. This is very heavy.
Tough.
Yes.
I looked at it. I didn't understand it to begin with.
Yeah.
This is a heavy piece. Go ahead, Anton.
So we're getting into the technicals here, but really what you need to know is we're looking at three different possible implied volatilities that we as zero DT traders have available to us that we would most likely look at when placing our trades. But the thing is, these three are usually different. So the three are, if you just look at the at-the-money straddle, what's the individual IV of that? And I think the easiest way to look at it, if you don't want to look at the individual options IV, just look at the zero DT expiration, look to the right where it says the IVX. That's going to be the first bullet point, the IVX of the zero DT. Then we have the VIX, which is the one we use all the time for our normal trades. And then we have the VIX one day, which is the essentially a mixture of the one-day volatility, same calculation as the VIX. But the thing is, each of these volatility metrics are different. So which one, like if we're saying what's the IV of these zero DTs? Well, do we look at the the IVX? Do we look at the VIX, or do we look at the VIX one day? And how do we best decide why we should look at one or the other? That's going to be the question in the study.
Okay, let's go to the next slide, Beth. So we did a study. We used using the past 8 months of SPX data for each of our considered implied volatilities. We computed the one-day expected percentage move at market open by dividing by the square root of 365, which is about 19.1, which is always the number that we've used on the network. Right. Compared that to the realized open to close change in the SPX to see how often expected move-based 0DT strikes would have been broken.
Yeah. So now, in order to decide which volatility metric is the best, we have to do some kind of test, right? And what we're going to do here is we're actually going to look at the realized volatility in the S&P 500, the actual moves on a daily basis compared to the actual movement in the S&P 500, right? I'm sorry, the actual realized move in the S&P 500 versus the expected move given by these volatility metrics. We're going to do the same thing to all these. We're going to look at the IV, divide by 19.1, each one of them. And we're going to see, okay, that number compared to the actual percentage move on the day, which one does a more accurate job of getting a normal distribution type expectation of movement in the S&P. And what we're going to find is actually something interesting, but I'll let you take the next slide first.
Here we go. So this is where I need your help, Anton, because breaking the slide down was hard for Tony and myself.
Okay.
It was hard for me. Tom got it, but he couldn't explain it to me. That's really what it comes down to.
No, it was honestly, it was hard for me. Go ahead.
So what we're going to look at here is, I think the most important is just the first row, the average. Okay. We're going to look at the ratio of the VIX to the VIX one day. Okay. What that tells us is how much bigger is the VIX than the VIX one day on average. Okay, so and this is a perfect example. Today falls right in the average. So if you look on the platform, the price of the VIX one day, you're going to see that it is 9.79, close to 10. Okay, if you look at the VIX, it's about 14.75. That's about 47% greater. If you look at the average of how much bigger VIX is usually than VIX one day, it's 1.47 times, exactly 47% higher. What that means is, on average, the 30-day VIX gives us a number, an IV, that's 47% greater than the one day. Okay. If you look at the second row, VIX over the actual IVX of the 0DTs, it's actually very similar. So on average, if you look at the actual IVX of the 0DTs, it's going to be very, very similar to the 30-day VIX. Not the one-day VIX, but the 30-day VIX. Okay, so the actual IVX of the actual 0DT option is going to be very similar to the 30-day VIX. Now, that also means that the one-day VIX is going to be smaller than what the IVX of the 0DT. So that's what this is saying. It's saying that usually the VIX is greater than the one-day VIX, but the 0DT IV is actually closer to the VIX than the one-day. So what does that actually mean?
So what you're saying is that the 0DTE volatility numbers are the best.
Well, yeah. So kind of. So this is just saying which numbers are like how do these compare to each other? How do the volatilities compare to each other without even looking at the realized movement in the S&P? Right. On the next slide, we're going to actually look at how do the realized movements of the S&P 500 compare to the volatility numbers. So from the last slide, we know that in terms of how big these volatilities are on average, the VIX and the actual IVX for the zeros are about the same. And the VIX one day is usually about 40% lower than both of those. That's what we know. Now, when we take a look at this is taking a look at, okay, how do those volatilities gauge the actual expectation of the movement in the S&P? So we know that theoretically, the very last row, we should have one expected move 68% of the time. We should see that. Two expected move 95% of the time, and three expected move about 100% of the time. Okay, well, we know from our previous research that the 30-day VIX actually overstates the theoretical move 80, like most of the time. We see the one expected move being within 83% of the time, not 68. We see two expected moves encompassing almost 100% of the occurrences when we look at volatility to gauge expected move, right? We know this. That's why we see volatility overstates expected move, right?
Yeah.
What that also means is if we look at the IVX of the 0DT options, that's also going to overstate by the same frequency. So essentially, if you want to place trades knowing that volatility is overstated, you're going to want to look at the IVX of the 0DTs or just the VIX, realistically, to give you a sense of, okay, this is the same type of way I'd put a normal trade on, right? So if you're putting like a 45-day trade on and you know that volatility is overstating and you want to put a 0DT trade on, you're better off using that same 30-day volatility to gauge how often it's going to overstate, because it overstates by the same amount. The IVX and the 30-day volatility. The cool thing about the one-day VIX, though, is that it actually gives us numbers almost the same as a theoretical expectation. So what that means is the VIX one day actually gives us the theoretical expected move for the day. When you take the VIX one day and divide it by 19.1, that's the actual theoretical move for the S&P for the day. But you take a look at the 0DT IV, that's going to give you an overstated figure on average. And that's how you can compare how much more overstated is volatility. You compare the 0DT IV to the VIX one day in this case.
So
does that make sense?
Yeah, it makes sense. But so how do we use this?
We use this by saying, okay, there are periods of time, especially when volatility pops higher and kind of stays there a little bit or is on the way down. We know that we have overstate, like usually as volatility comes lower, we're going to see option prices overstate what actually happens in the market. But we don't usually know by how much. And if we look at the VIX one day, what we see by this study is by how much does it overstate relative to expectation. We can use the one-day VIX to actually gauge what theoretically should happen. And then when we look at the VIX or the 0DT IV, we can see what's volatility pricing in. Now, does that mean, and it's always going to be higher, right? So like if you look at the VIX, here's a good example. You look at the SPX right now. You go to the 0DT IV. Right now, volatility is 20.5. IVX is 20.5. If you look at the VIX one day, it's 10. So it's overstating by almost double. Now, does that mean that the options are actually going to come in 50%? No, it doesn't mean that. But it means that relative to what theoretically is possible, you have more juice in the 0DTs right now than theoretical. And by how much? 20.5 in the IVX versus 10 in the VIX one day. That's how you can gauge how much overstatement there is by looking at the difference between VIX.
But how do I know what to do then? Like, what does that mean?
How does it help you?
How does that help me?
Say for the 0 day.
I think if you want to start trading the 0 days and you want to be, and you don't want to put a lot of risk on, you don't want to start super big, you should look for a big gap between the VIX one day and the 0DT IV. That's the biggest takeaway, I think. So if you're in a market where, you're seeing the 0 day IV or the 1 day IV trade at like 13 or 14, and then you look at the VIX one day and it's like 13 or 14, right? You're going to be like, okay, well, maybe I won't do the trade today because the volatility is very cheap and it's almost close to theoretical, right? But if you're looking at the IB right now in the 0 days and you're like, oh, this is trading at 20, but VIX one day is at 10, and you kind of want to dabble in this market, maybe this is a good time to do it because this is the highest chance of an overstated premium for those 0DTs. So that's how you would use it.
Okay, so based on what you're seeing today, assuming, I don't know what the normal range is, but 2010 seems like it's a lot. So that would be, it'd be a good day to sell premium in there.
Yeah, or buy a butterfly or whatever. Yeah, it would be a good day to start. Yeah, or like, especially if you're somebody who doesn't trade the 0DTs and you want some place to start, would it be better to start when the gap is small or when the gap is big? I would say when the gap is big, because then at least you get the butterflies for cheaper, and based on this study that it usually overstates what actually is seen in the VIX 1D. That's what this study is saying. Does that make sense?
Totally. I got it. Okay, keep going.
Okay.
Carry on.
So you want me to take this last slide, even though there's words on it?
No, I'll do it.
Okay.
The VIX one day, so that's divided by the square root of 365. What does that mean?
It's about the same as 19.1.
I guess what he's trying to say is, no, you can read it, Anton.
It's about the same as 19.1, okay?
Yeah, about the same as 19.1 from the slide that we saw
But
a
it
moment
did
ago.
an excellent job, just so you know this, Mr. Batista. It did an excellent job of predicting the open to close percentage change in the SPX, which is just what Anton said, in keeping the normal distribution statistics. So the VIX one day was pretty damn close. Almost by coincidence, the zero DTE at the money implied volatility and the 30-day VIX were usually very close, but tended to overestimate the one-day SPX changes. So while using the VIX, I guess this is the takeaway, while using the VIX or the zero DTE at the money implied volatility, it results in, quote, safer trades. The VIX 1 DTE gives us the best information for deciding on strike placement, while selling the zero DT SPX options at market open. Let me think about that for a second.
Yeah, so the safe is relative, right?
The VIX one day gives us the best information deciding on strike placement.
Yeah.
Okay, so let's do an example of how you would use that.
So whenever you put a 16 delta strangle on, right, this is a good example. You put that on because you know, theoretically speaking, it should be within expectation 68% of the time. But realistically speaking, we see it be 83% of the time. That's what that's what this piece is saying, that when we use the VIX one day, we're getting a sense of where the theoretical 16 delta is, right? But the actual volatility that we see in the zero DT options, that tells us what the potential overstatement is. And by how much bigger it is than the VIX one day, that's how much potential overstatement there is. That's why we say it's a safer trade, not because there isn't not because there's less risk, but because there's a greater probability of an overstatement on that day for the zero DTs.
Got it. Thank you, Mr. Anton. That was beautiful.
Thank you, Tom.
Thing of beauty, Anton. Thing of beauty. Appreciate your time, man.
All right.
We're going to take a quick 90-second break. We got no Scott today, so you want to go to phone calls?
Yeah.
If you call in, we'll go to your phone calls at 855-238-2789 or 855-BE-TASTY. I'll open up the phone lines right now. Number will be below momentarily. Give us a buzz, 855-238-2789 or 855-BE-TASTY. Phone number to call. We'll go right to your calls immediately, if not sooner. We'll be back in 90 seconds.